Welcome to this webinar for White Coat investors. We're glad you're here. Today, we have a number of people I should introduce at the beginning. I'm Jim Dahle. I'm the founder of the White Coat Investor and its CEO. With me today is Brett Stevens. He is our COO. If you have been working with us in the real estate space for long, you know of Brett. He sends you lots of emails, and he'll be with us today on the webinar as well. We have two very special guests here today. We have Chris Funk and we have Jim Sheils. They are principals with Southern Impression Homes, as well as its subsidiaries, including JAX Wealth Investments, which is how we're going to mostly refer to the company today is JAX. And if you want to learn more about JAX as you watch this webinar, you can pull it up at whitecoatinvestor.com/JAX, JAX. But what we're going to be doing today is Jim is going to be presenting, as well as Chris is going to be presenting some slides, telling us about their company as well as their investment opportunities. And then we're going to have a question and answer period and try to answer all those questions that you could possibly have about the company if you're interested in investing. And again, if you need more information or if you're ready to invest, you can go to whitecoatinvestor.com/JAX. All right, let me turn the time over to you, Chris and Jim, and let you tell us a little bit more about yourselves as well as the company and the investment opportunities.
Great. Thanks for having us, Jim. Thanks. Good to see you again, Brett. It was a pleasure having you out in the Florida market with us. My name is Jim Sheils and my partner, Chris Funk. It's a pleasure to be here with you today. We've heard incredible things about White Coat and looking forward to showing you about our build-to-rent venture. Chris is going to be on the slides today. We're in separate places, so he'll be moving the slides. Chris, if you want to move that slide. We are, at this point, one of the number one build-to-rent ventures in the U.S. It came through a lot of hard work. And we're the parent company. Southern Impression Homes, so you understand, is the parent company to what we consider one of the most successful build-to-rent ventures in the United States. Next slide, Chris. And what we specialize in, individual investors building successful rental portfolios in high-growth, landlord-friendly markets. Our main focus is Florida. Next slide, Chris. And we focus on new construction. This is desirable neighborhoods, maximize landlord profits, better inventory, less tenant turnover, lower maintenance and repairs, and a better overall growth strategy for both rents and values. Click that one, Chris. And then it's full service, acquisition, building, construction, property management, and ongoing client support and education. Just so you know, this was founded by Chris and his father. And I came on as a partner. We've done over 8,000 transactions together. The company right now, we've done team building of 14 successful JV funds and registered funds over the last 10 years, with net investors showing IRR ranges from 11% to 28% for passive investors. In 2021, we did over 130 million in sales for new construction, and we're on track to complete 900 units new construction in 2022. And we've created approximately over 110 million in equity for our investors through property ownership and over 26 million in annual recurring rental revenue. And I think it's important for you guys to know where we came from. Most clients come to Southern Impression Homes. They were looking for an alternative to the stock market for cash flow, real estate appreciation, a great hedge against inflation. And the way we're able to do this is Chris, myself and his father actually started in the bulk foreclosure game. We had always done bulk foreclosures. Rehabs were the way we went. And after doing bulk foreclosures with some of the biggest institutions and hedge funds in the world, Blackstone, Americans Home for Rent, we changed our business model years back from working with the institutions to working in not only new construction instead of old rehab fixer-uppers, but new construction along with individual investors. And this gave us the ability to do a lot of things. This was a unique platform because people usually to the size of our building company were only wanting to cater to the larger institutions, but we wanted to work with individual busy professionals and get them better returns than the Wall Street institutions were getting. And we do that because we use our collective buying power, the collective buying power and our managing efficiencies for the scale we do. By doing this scale and doing it with individual investors, we increased our volume and success a lot more than most build-to-rent ventures out there. And something we actually learned was working with individual investors. Our building lines with our banks actually saw us as a lower risk for doing build to rent than working with the large institutions. And that benefits everyone involved, including white coat investors now. We focus, as you see on the slide here, in new construction high growth markets. That's Jacksonville, Ocala, Cape Coral, Palm Coast, Citrus Springs, Inverness, Fort Myers, Englewood, Punta Gorda, Port Charlotte, Lehigh Acres. Those are all Southwest Florida, and also moving into Palm Bay and Homosassa. There's a couple of things we look for high growth. First is economic growth. Are there jobs moving there? What is the family income compared to what prices of properties are? The next thing we look for on the next slide is population growth. We don't want to build property where there's not extreme population growth. And I think a lot of you know, Florida has had just that, extreme growth through the pandemic especially. The third thing that we look for is affordability. I'll talk about that a little bit today, but like some of our major markets here in Florida, the median value compared to some of competitor markets out near the West Coast, like in Utah or Idaho, are $300,000 more, the median price, than what we are building here in Florida. So that affordability brings about cash flow and also a better safety score for investors like white coat investors. The fourth thing that we always look for is desirability. Something's got to be drawing people to the area. When Chris and I first started this, we were really looking at the baby boomer migration. Not that baby boomers were living in our houses, but they were creating jobs in these areas for people that worked in these industries to live there. The pandemic, as tragic as it was and hard as it was, really put a shining light on Florida. So the desirability of Florida has only grown through this. And then the fifth thing that we look for, obviously, as a builder, is healthy supply and demand. You don't want to be building where the population isn't growing. So, for example, before the pandemic even started, Southwest Florida, the main municipality near Fort Myers, released to Chris and I a report. And it showed that we were already 3 years behind on needed rental inventory before the pandemic even started. So we like to have that wind at our back. So wherever we go with our investors, we want to go in an area that obviously has a very healthy supply and demand in our favor. Next slide on that, Chris. So Panther Creek, we figured the best thing to do is say, well, what does a build to rent community look like? Let's see something in action. So Chris, do you want to take over and just kind of explain to everyone out there what we're looking at and a little bit about the build to rent model overall?
Yeah, sure. So this is Panther Creek. This is an 800 lot community that we developed here in Jacksonville, Florida. And actually, Brett, this is one of the properties you toured when you came out here to check on us and vet us out. So I don't know if you want to say a few words here.
Absolutely. We walked through a number of homes in this community, and actually I think drove almost every street and kind of checked it out, and it was impressive both in scale and in quality of homes. So I enjoyed, especially coming from a building perspective, walking through a number of those properties, and was impressed. They're great.
I appreciate that. Yeah. So this community is one where we did a hybrid between retail home sales and build for rent sales. So right now we're traveling down one of the roads. This was actually one of the build for rent pockets here, and then you'll see as the camera pans out, there's quite a few home builders in there. So we sold lots to KB Home, Richmond American Homes, Ryan Homes, and Drees Homes. Those are all national brands that you'll probably recognize. So in addition to what we built, we sold lots to these other national home builders that sold retail homes. And the beauty of that for our clients is, you've got a good mix of the rental and retail home buyer within that community. And this is one where we've got multiple phases that we're building our way through. So our clients, had the opportunity to get in much earlier into the community than say some of the home buyers that are getting in here at the end. I don't know if you saw earlier on, there was a big 27-acre pond that we're building back there. It's 27 acres. I think you call that a lake at that point in time. It's actually, I think, the second largest lake in Jacksonville. But the point is we're still developing that out, which has plenty of time for prices to continue to increase while the community is finishing up. So this is, like I said, one of our larger ones. It's 800 lots. We do everything between 20 lot communities and 800 lot communities.
Well, a couple of advantages too. When you see this, why did we go from new construction again? Because Chris and I wore the rehab badge on our on our chest for many and many years. But going from new construction, we learned a lot of things. There were a lot of advantages to going new construction. Now, it was a bigger barrier to entry to go from rehabbing old homes in volume to going ground up. But what we found overall really passed along to our investors that we worked with. The first thing is lower cost of insurance. I mean, when people say to us, it's funny, Chris and I, we have a lot of investors will come out of California or Utah and they'll say, oh, insurance though in Florida. And we kind of scratch our heads. And once we send them the quotes, they go, gosh, this isn't what we thought it would be. And we take that as a compliment because our insurance companies love our new construction homes. They're built in the right areas. Very, very few, if any, are built in flood areas. And the new construction home is a lot easier to get insurance on. Another thing that's a big advantage of new construction is the lower first-year property taxes. A lot of the times with our clients that buy that first year of the property, they will look and say, wait a minute, the property tax that you estimated is much, 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 much lower. And that's because a lot of our owners for that first year of ownership, or at least a partial of that first year, is based on land value instead of full property value. So that's a nice thing for an extra cash flow boost as well with our new construction. Another thing with the new construction is lower cost of maintenance. There is something that I don't know, Jim or Brett, if you've heard of it. We used to call it the 3-year curse. And let me tell you, the 3-year curse, you could do a new roof, new heating and cooling, new plumbing, update kitchens, baths, the whole nine. And somehow with these older houses built in the 40s and 50s, and Chris and I own a lot of them, but by year 3, there had to be a big jump in your maintenance and repairs. And so when we went into this new construction model, we wanted to see if we could beat the 3-year curse. Now being 7 years in on new construction fully, we've not seen this 3-year curse come out in 7 years. So that's making us feel good because we were able to build the property with more durability, better aesthetics, but also hold those costs down. Also, our turnover costs. So when a tenant leaves the property and a new tenant has to come in, first of all, the turnover is less. But one of the big things is our costs went down about 75% to turn a property because we were able to better match paints. We had more durable vinyl plank flooring. Things that we did to the properties helped the turnover. You will never hear Chris and I use the word carpet. That is a very, very bad word to use as a real estate investor. Chris and I combined bought several properties cash just on our carpet bills alone from turning our portfolios. But these are little things that we've learned and we pass along to our clients. Also, with this lower cost of turnover, we don't have to worry about vacancies as much and credit loss. Because if you have a tenant that's moving into a new construction property that's more durable, more pretty, we're seeing that the turnover is less, which lowers vacancy. And obviously, no one wants vacancy. Now, another thing of vacancy that I do have to add into there, I think Brett and I were talking when he was here, we were very lucky through these national moratoriums. Nationally, there were different moratoriums going around in different states. Florida had one of the friendliest landlord atmospheres in unknown times like the pandemic and even before that. So we're very happy with keeping vacancy low. I think that you want to have landlord-friendly laws in your corner if you're going to be investing in certain states. Next slide on that, Chris. So the build-to-rent criteria. There's a couple of things with our build-to-rent. Our average prices are $250,000 going all the way up to $950,000. That would be some of our quads or even larger developments in Southwest Florida. Average down payment, 25 to 30% down. So it's the average down payment. Obviously, most banks like financing us, including Fannie Mae, Freddie Mac, and a lot of the non-QM average banks as well. Average days to rent. This is something really important, obviously, for our experienced people out there. Great, you have a new construction property, high growth area. How long does it take to rent? Our average right now is showing 17 days. This has been an astonishing time where we are just seeing such a demand on rental needs. Again, that's 17 days the average. Something nice that we couldn't do with our older properties either. All properties come with a state-mandated builder warranty and a 10-year structural warranty. So the 210 warranty is something that we can give on new construction. We could never give that on the older properties. Next slide on that, Chris.
But tell us what you mean by 210. I think a lot of people probably aren't familiar with that term.
Sure, I'll jump in
Yeah,
there.
Chris, do you want to
Yeah.
explain that?
So 210 is essentially an insurance policy that we buy on behalf of the client. So if there's a 10-year, if there's a structural issue, within that time period, then there's a policy in place that will backstop us, us as the builder. So we've got our builder warranty, which is a 1-2. So there's certain portions of it. It's basically bumper to bumper year one. It's mechanicals through year two, which are covered by us, the builder. And then you have up to 10 years on structural, which is covered by your 210 policy.
And so all these properties are pre-sold. So you have a pre-sold while under construction, it's a 10% deposit, and the average build time is 4 to 12 months build time. And then while it's being built, obviously this is a really important thing. People are working with us from all over the country and sometimes across the Atlantic and across the Pacific. So they ask, how do we keep track? With our client portal, investors are able to watch the property go from a cleared lot to a slab to the studs going up to the roof, all the way through pictures and videos. They get to watch the progress of their property being built. They said they all makes them feel like they're here without being here. And that's been a really good guiding point for working with our investors. Another thing that's great to know is, well, how do these properties do? So obviously by doing these for over 7 years now, we've had some people go to full cycle, meaning they've bought the property, they've held it for rent, and then they've sold the property. And these investors, they've been averaging IRRs ranging from 18 to 56%. So I think the proof is in the pudding for the overall criteria that we're doing for build to rent. Again, we are looking for high growth areas with those things we talked about before: population growth, economic growth, good affordability, desirability, something taking them there, and healthy supply and demand. And what we find with going into these high growth markets in Florida, we can get just that. In addition to the returns, I don't have to tell many of the real estate investors out there, there's some really good income tax efficiencies, through accelerated depreciation, holding the asset, and then long-term capital gains tax rates at the time of disposition. So that's obviously a big thing to your advantage. Now, some of you are asking the big question about, what about financing? Interest rates have climbed. Where do we go with interest rates? One of the big things that we do look for is, again, being an all-service build-to-rent venture. We're always trying to build the best property, manage it the best way, get the best service for our clients like you. But that's going to also include things like insurance and things like financing. And we've been able to uncover some special financing programs directly tied to our new construction property that are available with lower interest rates that aren't offered directly to the public. Now, that's something we'll be able to talk about more in different client discovery calls, but know that offering financing options and having different lenders lined up that you can work with. And again, we don't have any of a financial ownership or affiliation with them. We just like to refer to people that get the job done. And we've tried to really gather a good pool of investors that do that, meaning investor in banks that will take these types of loans, and also find different loan programs that are special, especially in these times, to get you the best rates possible. Now, a special client benefit, as Jim talked about, JAX is the company that you'll be working with. JAX is right a part of Southern Impression Homes and a very important arm of it because this is who the white coat investors will be working with. When you start to step into a property, you want to make sure that you're receiving certain care, attention, and awareness. And that's what the job of JAX Wealth is, having special client attention and preference in inventory selection, pricing, financing options, insurance, ongoing education, and more. So you're a part of the process. You're never alone. You're constantly receiving updates and educational information about the markets and where we are. And that seems to serve people really well because no one wants to feel lost in this process. So we've designed an entire company to make sure that they're taking care of what I want to call more elite client bases, like a white coat investor. And obviously, along with this, no investment. I remember an investor mentor of mine saying to me many years ago, saying, Jim, if you don't have management, you could buy it for 30 cents on the dollar and still lose money. I think management is extremely important. Before Chris and I knew each other, this is actually good piece of history. When I left California, because I started my bones in Bakersfield, California, doing bulk foreclosures many, many years ago, 24 years ago. When I came here about 17 years ago, I hired and fired 4 property managers after buying my first 100 properties. I didn't like that. That wasn't fun. So the way Chris and I actually came together was him and his father started to manage my portfolio. Because what I found was if I was going to keep buying property, I had to get this management thing sorted out. And unlike some investors out there, I don't like managing my own property. I would rather hand that off, do the deal part. So having good management is important, and that's where Suncoast comes in. We currently have over 2,000 properties under management in 5 different markets. And we really, really look hard on the leasing and management right through to completion on the new construction. With this integration of the builder relating directly to the manager, that's an absolute key thing to get things leased and income being produced seamlessly. I don't know, Jim or Brett, if you guys have ever had, I know, Brett, you've been in the building game. It's great to have a builder warranty, but what if you can't find the builder? That's not a good feeling out there, to not be able to find the builder. So the good thing is on every file, on every property that you buy, your warranties are already going to be in the file with Suncoast Property Management. And I think that is a key seamless thing that we've put together because we don't want to be guessing on warranties, who covers what. We're able to answer all those questions seamlessly so you know that your new construction property has been moved over to a property manager that doesn't want to create problems for you, exact opposite. And I think that's something to keep in mind. So having these 3 working together, the best building, the best client concierge, and the best management is, I think, what has allowed us to grow at the speed we have grown at. And one of the things I think that is important to talk about, it's a wind at our back right now, is inflation. It's a big subject out there. I'm sure you guys are talking about it on all the white coat chat boards. And we see this as a good thing. Chris, you and I have great conversations on this. Do you want to talk about the triple crown of inflation?
Sure, yeah. So for us in real estate and landlord and property ownership, this has not been a bad thing for our industry. And you always see inflation to some degree is healthy. We have too much inflation at this point in time, but real estate and rents have gone in a very similar trend to the stock market. They go up and to the right pretty regularly. And so for part of your ownership, you're looking for that inflation. That inflation is what causes you to have appreciation in a lot of cases. So when we look at the asset price inflation, debt debasement, and cash flow enhancement, I'm going to focus on cash flow enhancement and debt debasement first. So what I love is what we've seen from a rental perspective in the last couple of years. We've seen massive rent growth with all of our buyers that have locked in on a fixed purchase price. So they've bought a property, they got 75, 80% financing on that property, and now the rents continue to increase. So now they're paying that mortgage down with inflation adjusted dollars, or I should say their tenant is paying that mortgage down with inflation adjusted dollars. So we've seen some just massive cash flow enhancement. I take a quadruplex. Jim and I keep something in all of our communities. So quad project that we finished about a year ago, maybe a little more than that, a year and 3 months ago. I had my first renewal on my particular unit that had reached the 1 year mark. And the rents at that renewal time went from $1,250 up to $1,625 in a matter of 1 year. Now that's pretty rapid growth. We saw some crazy numbers in the last year, but to put that in perspective, that's an extra $1,600 a month. So it's like buying a 4-unit building and getting paid for 5 1 year later. So the cash flow enhancement has been massive. We continue to see massive cash flow enhancement on an ongoing basis. That's a meeting that I do not miss ever, is our weekly leasing meeting. And we've been ranging for properties that have turned over. So if a property was leased a year ago and turned over, we really watch those numbers closely because that tells us what the rents are doing on a unit by unit basis. And those rental increases have been ranging from 17 to 23% increase. And really, that's been over the last 6 months. So, we're seeing right there around a 20% range. So what all that is doing, for your asset price appreciation is also great. These are cash flow investments. So as the rental rates go up, the value of the property goes up, of course. So we've seen obviously great appreciation there. But one of the things that we've had some of our clients struggle with is they say, well, we're in this inflationary period. Do I still want to put as much debt on the property as I otherwise would? And I would argue that putting debt on a property in an inflationary time period is really the best time to put debt on a property. So you take for instance a quick and easy example. But let's say that you put 20% down payment on $1 million property. So you put $200,000 down. Well, if we see 10% inflation over the next year, now all of a sudden your property value has gone up from being worth $1 million to being worth $1,000,001. You put $200,000 down. So you had a 50% gain on your equity, your equity into the property over that 1 year time period. So this is, to me, this is the time to use debt. And I won't say that it really doesn't matter what the interest rate is. You always want to get the lowest rate that you can. But in an inflationary time period, being able to get debt and take advantage of as much inflation as possible is really, really where you want to be. That's where I want to be in my personal portfolio. So and then last but not least, this debt debasement. This is really a factor to be taken into account while you're holding the property. So when your debt is being debased, what that's talking about is the value of your mortgage. So when that lender lent you that million or that $800,000, they lent it to you at that current dollar value. Well, with inflation, those dollars are no longer worth what they were, but you're paying that mortgage back with inflation adjusted dollars. But the mortgage itself is not inflation adjusted. So again, the bank is getting the short end of that stick, which is why you want to have an inflationary period, as much debt on these properties as possible. Now, when you look at all three of them together, you say, well, asset price inflation and debt debasement, those kind of work together, and that's correct. So when you sell that property, you're recapturing all of that, all of that debt debasement because you're selling the property and you're paying it off with inflated dollars, but you're only paying off the dollar that you borrowed however many years earlier. This is a great article down here. Whenever you get a chance, take a look at that. It gives one of the most concise explanations for these three principles that I've seen.
So overall, I think we get asked about inflation 15 times a day. No, no lie. And so we want to make sure you understand for certain things, I think inflation is really bad. Most of my mentors, again, that came out of the 70s of real estate, older guys now said inflation was their best friend. If you get in at the right time, if you fix your debt, inflation could be one of your best friends as a landlord. So we are actually looking forward to inflationary in times and the fact that we're seeing here on all of those here in Florida. Chris, do you have the next slide?
Let's pause for a minute here and just recap, kind of bring people up to speed about the investment we're talking about so far. This is what's referred in the industry as a turnkey investment. And this occupies kind of a special place in the real estate spectrum that I've talked about so many times before, where way on the left side, you have direct real estate investing with various benefits, but also various, responsibilities and certain amount of work there. And on the far right side, of course, you have lots of passive real estate investments where you don't have as much control, but you have almost no work to put in. And a turnkey investment is kind of at the passive end of the direct part of that spectrum, in that you have control over the investment. You get to decide when you sell it. If you want to exchange it, a 1031 exchange to another property, you can do that. You can have some input into, what it rents for, et cetera. But at the same time, you've got somebody else doing the management. You've got someone else doing the building and the maintenance, and nobody's calling you for a 3 a.m. toilet call. And so you get a lot of the benefits of being on the passive side as well. So when you go into this investment, you own the home. And in this case, the home hasn't even been built yet. So you get to watch the home being built. Then they can put a tenant in it and can manage it for you. And you get to enjoy the benefits of direct property ownership, even though you live nowhere near Florida. And so that's kind of the investment we've talking about thus far. We're going to move here shortly into talking about other opportunities that are available through JAX.
Perfect. Yeah, and so again, the high majority of our people do come to us to build portfolios. That's what we're best known for, Jim. That's where Brett came and was looking even for some stuff that he was working on. The new construction has really been an upgrade to an old game. There's been lots of things out there, including us, where we used to do it for some of the biggest hedge fund groups out there. And the new construction was a game changer, again, because we could pick better inventory, better placement, less headaches, less maintenance and repairs, less turnover. And that's pretty key for people, as you said, Jim, who want to stay on the passive end. We want you to be passive. Our goal is 10 to 15 minutes a month, and that's all it should take. Because if not, we're not doing our job. And the new construction with good management really allows that to happen. Now, but to the side of that, people say, well, we love the build to rent model. We're reading all about it. We know that a lot of bigger industry titans are going towards it. So we think it's got a good baseline to invest in, but we want to be more passive. You might be past the age where you've built a portfolio, but you want to be a part of it. We have a solution for that. A lot of people want to invest in it on the front end. And this is our front engine of the business. Chris, do you want to talk about the front engine of the business a little bit?
Sure. So, we obviously are building a lot of homes, which means that we have to buy a lot of land all over the state. So, Jim mentioned all the areas that we're building in currently, and for these land acquisitions, we raise private equity through our SI Homes income funds. And so, what that means is the SI Home Income Fund is essentially a captive finance vehicle for Southern Impression Homes and our development entities. So investors invest equity into the fund vehicle. The fund then loans that money out to a development project or a lot purchase or any variety of our development projects, but only projects that are owned by SI Homes, Southern Impression Homes, or a wholly owned subsidiary of Southern Impression Homes. So we don't lend money to anybody else, just our projects. Then as we build through those projects, we're paying a current interest rate to the fund, and that interest rate comes every month, which means that we do a distribution to investors every single month. So every month, the month after you invest your money, you receive an 8% preferred return immediately. And then as we build and sell through properties, 10% of the profit that is gained on those projects also gets paid to the investors. So it's current income, and then a kicker, which is how we get the IRRs up so much on this project to that 12 to 16% range, is the 10% profit share. So even if halfway through the project we refinance all of the fund dollars out of a project, and oftentimes we'll do that through the use of our builder lines of credit. Still, because those fund dollars touched that investment, when that ultimate property sells, then 10% of that profit goes back to the fund. And when we are in the middle of that process and we're refinancing, the principal goes back to the fund along with the any interest. Then the principal gets reinvested in a new project, so that we have this revolving. It's essentially a revolving line of credit that the investors continue to keep their money to work all the time. So there's no downtime on that capital because of the way that we've structured the deal. And I think Jim, did I miss anything on there?
No, I think that one of the main things that is been highlighted for us is, I know some funds now are requesting 200, 300, even $500,000 minimum investment. Our minimum investment still is at $100,000. And it is offering for IRA and qualified funds. There's no debt in our income fund, so we can take IRA money, self-directed 401k money, and we've had several investors do just that, and it seems to be a great system for them for the rollover effect and to see it grow.
And this is actually our fourth fund of this type. This type of investment vehicle. This is a $20 million fund. I think we're a little over $10 million committed to this fund. Fund three was $20 million as well and was fully subscribed. So, these have been very popular investments with our clients. And we've actually seen a number of our clients invest in both the fund and direct real estate ownership.
Yeah, I think there's something here that's pretty noteworthy compared to other debt funds is the high targeted IRR. I mean, if you look at most debt funds, you're looking at 6 to 11% is what they're really aiming at and what you get out of them. And this is 12 to 16%, so significantly higher return. And I think there's a few reasons for that. One is there's a little bit more risk being taken. They're not all first lien loans. They're first lien loans when the property itself is bought, and then they become second lien loans. So there's a little bit more risk there, and that's part of the reason. But another part of it is the fact that you're getting this 10% kicker. This is very unique. I mean, I've got a number of debt fund investments, and none of them have this sort of a kicker in them. None of them give you part of the profit from the sale. And I think you can get that because these guys are on both ends of the deal. They're on the equity side and they're also on the debt side. And then, of course, with the 5-year term, there's a little bit of an illiquidity premium there, right? Because your money's, there's some redemption options there, but the expectation is that you're going to invest for 5 years. And so you get a little bit of a premium for being willing to be illiquid. And in the end, instead of getting, 9 or 10% out of it, you may be looking at 12 to 16%. And so that's something I think a lot of people find attractive about this particular fund.
Yeah, it's a great point. I'm glad you brought up the first and second mortgages. So, just to kind of round that out, so when we buy the land up front, before we start building on the property, that's when the investment is in a first position. But then when we use our builder line of credit to go vertical, meaning that we're building the vertical structure, that's when the note reverts to a subordinate position to our senior lender. So our builder lines of credit need to be in first position. And I think it's important to note that the vast majority of our builder lines of credit, we personally guarantee as well. So, this is not a situation where, we're not fully invested in the project. We have a lot of equity in all of our projects and in our companies, as well as, being on the hook for the personal guarantees to finish the vertical construction. So, it's a long way to say that we are heavily invested in the success of the project, and even to the extent that each one of our funds has a $200,000 backstop. So if for any reason there was not capital in the funds to pay the preferred return, we have to pay up to $200,000 of that out of our pocket. It's never happened, but there is a backstop there just in case.
I think one of the key things too that people have asked about stress testing our fund. What if things go wrong? The way that we set this up, unlike a lot of builders out there, a lot of builders are building properties, doing lots of nice add-ons to them and trying to make the best spread on usually nicer houses than what we're doing. They're a little more higher end. And those are great until the market goes a little sideways, because what happens then is they're stuck with an asset that they don't want to rent out, nor would it cash flow. So our whole model has been tried to build, if things just all of went stagnant, the way that we've whiteboarded our business, it looks like we would be able to, even if rents drop 20% and properties just stop selling, that, due to our margins and the deposit that we receive from investors, we would be at such a low basis that we would be able to finish out and rent our own properties and still not only preserve the capital of our investors, but pay the monthly pref payment without an issue. And that's one of the key things that a lot of people have liked coming aboard with us, saying, what is your backstop? What is your safety score? And that's really it, that, we don't underwrite a piece of property without the ability to put a cash flowing asset on it. And that gives us a lot of, just a lot of grounding for the unknowns, because that's what we came into this first as real estate investors that rented property. So we wanted our building company to reflect that same principle.
Yeah, I think that's a great point, because it really hits on both sides of the fence, right? The passive investment as well as the active investments in the properties themselves. this is the hedge against inflation, right? We don't know what's going to happen. Is inflation going to continue to run rampant, or is the Fed going to put us into a recession? I'll kind of jump back to where I was pronouncing my love for debt earlier on in the presentation. I love debt on cash flowing assets. Where something is paying for that asset. You don't have a dead asset on the ground that doesn't have any. That's really just burning. That's burning dollars. When you have something that's paying for that debt, you're really safe in almost every scenario. So, we look at the inflation running rampant. Okay, well, as a real estate owner, uh, that's not a bad thing. I love it. Has it bumped up interest rates? Yes. But if we go into a recessionary period, we're going to have a lot more tenants than we even do now, and we don't have enough inventory for the tenants that are coming to the state as we speak. So you would drive a lot more folks into a rental position than we already have. So both the active ownership and the fund have the same hedge feature in that there is a rental component to the project that will help survive any sort of environment that we get ourselves into, or at least the two most likely alternatives that we see currently.
Want to open up for any questions that you might have, Jim, you or Brett?
Sure. Let's start with I think a question that a lot of people are probably thinking about. I mean, in this model you have, you're buying a lot and then the home gets built on it. It's new construction that comes with benefits in that you don't have to fix a bunch of stuff in the first few years, maybe 7+ years. The downside, of course, is there's no tenant in there the day after you buy the property. It's just an empty lot. How long does it take to build the homes on average, and is that new construction worth the wait?
Yes. So average construction time, Jim, right now is 4 to 12 months. And I'm going to say yes. And I'm going to give you a couple of very clear reasons why. First reason why is the 3-year curse. I explained that to you. The 3-year curse is something very, very important to understand. And it's something that we avoid. And it's something that you don't want to have as part of your portfolio. The new construction takes that away. The second thing is we mark our properties, although people say to build them upwards, we mark our properties at current selling values and current rent values. So even though it's just a lot today, Jim, and it's going to take a while to get built, we do our numbers at what could our leasing department rent it at today? What would that ability be today? So what we see a lot of the times, and again, we don't promise this, but it's been in the inflationary times, especially, been very positive, where our people are going through this building process and they say, well, our 10% deposit, is it actually working for us? Well, yes, because for the high majority of properties we've seen close through this building period, guess what? The rents are a great deal higher than what we had promised. The values have even gone up. Now, we can't promise that, but normally, as Chris said with the Triple Crown, these are inflationary times and this is what happened. So your money is actually working even during the construction period. And we've gotten many, many, many email thank you saying, thank you for getting me this higher rent. And we said, hey, we didn't mean to underpromise so much. We were just going at today's value. And from what's expected for Florida, we're going to see that again. And that's really, really important for knowing that it's worth the wait. We have many clients that, again, were used to the older properties, but now avoiding the 3-year curse and having this build up through that actual pre-construction year when they don't even have any risk of landlording has been a really good thing.
Yeah, and just to add to that, we run the kind of early pro forma when the property is sold, and then the post lease up, which, as Jim said, our lease up right now is only 17 days post closing. It's actually not even post closing necessarily. It's on the market, and because the property management and the building arm are so closely connected, we're marketing it before there is a CO on the property. So in a lot of cases, that's a 17-day marketing period, but it doesn't even mean the property was fully ready for 17 days. And the owner is closing 15 days after completion. Interestingly enough, in the office right now, the talk is, should we let the properties be on the market a little bit longer and push rents even higher? But we try not to get too greedy there. We want to make sure that we're filling them up fast. But they have really been leasing up, significantly more than the initial pro forma, which has been great to see.
As we're talking about this build to rent model, and I've been down, Chris and Jim, and walked through some of your homes and learned this process. But we've spoken about passive versus active, and how this kind of bridges, as Dr. Dahle spoke a few minutes ago, bridges that spectrum when someone's buying one of these homes. What is the process like? If a white coat investor comes in and says, okay, I want to participate in this program, what are the steps and what is the process like for one of those investors?
Yeah, great question, Brett. So we've tried to make it, again, as seamless as possible. The first thing is we want to get a feel of what you're wanting. So, for example, Brett, you came and said, look, I'd like to be in a neighborhood that probably has, room for growth, amenities, and we looked at Panther Creek. That was a little different because it was me and Chris. Normally, you would have been assigned to one of our sales directors. Probably Jennifer has been our director of sales for quite a while. She'd be your first point of contact. We'll get a feel of what exactly you're looking for. Single family, duplex? Are you looking for higher appreciation or higher rent yield? We want to get a feel for what you want. And then we pinpoint the properties. As we get a feel of what you want, as properties are starting to get released, and Chris and I try to do inventory every month, we kind of have that nice matchmaking where there might be something ready for you right away, or maybe a few weeks from now, or even a few months from now. And we say, hey, here's the property that you wanted. Here's the pro forma of how it works. So there'll be an onboarding system to get you started for which property you want. Now, once you decide on the property, then it's a very fluid system of standard purchase agreements that are going to be filled out, setting up of property management, setting up of your construction portal, deposit, setting up with the title company. Again, all of this is under our umbrella so that our goal was always be a part of the process, but never feel overburdened or alone. But we want you to be a part of it. So we have about a 10-point system from when the day you identify the property to making sure you're seeing it being built, to making sure you're getting set up with management, to making sure financing is going along the right way, insurance. So we kind of just have you walk through our system that we've done with now hundreds and hundreds of investors. That goes right up into the point of closing, where obviously at the point of closing, the property goes right from our building company to Suncoast, the management company. And then, we're hoping to hear from you once a month just to thank you. That's the overall goal with things. But again, if you just came here, for example, Brett, and said, okay, I'm going to buy a property here. Well, you'd have to figure out your title company, your lender, your insurance company, your management. All of that is taken care of, and we drop the pieces in as we go.
Well, that's certainly the beauty of that model. So if someone's looking at this, how much time would they expect to spend getting through that time frame and kind of getting to purchase, do you think?
Going through the purchase, you're looking at about, again, it depends on how far along the property is in the different build areas. You're looking at about, for the overall build, 4 to 12 months.
Awesome.
Yeah.
So the financing you'll be able to get pre-qualified in a day.
Yeah, the initial process is, if somebody comes and they have a particular market they're interested in, it's relatively quick. We have specific inventory that's set aside that will be set aside for white coat investors to be able to see and review. So there will be a limited number of properties at any given time to choose from, because as material costs have kind of gotten crazy, we're waiting until we're a little bit further into the process to sell the homes these days. We used to sell them before we even had a permit, and now we're waiting a little bit longer in the process. So there's only a limited number of properties that have a slab in the ground for our clients to choose from. And, so they choose the property, and then, they can get through the entire process in as quick as a day. And by a day, I mean, a few hours, and, spread out over over a few days period.
Excellent.
Let's talk a little bit about Florida. All these investments are in Florida. Florida has a couple of huge things going for it. One is just the general trend we've had for the last few decades, where people are moving from the Northeast and the Midwest into the Sun Belt, providing kind of a tailwind for investment values there. But also, it's a tax-free state. So somebody who lives in Texas and wants to invest somewhere else, if they come to Utah, they're going to be paying 5% tax on their income out of property in Utah. In Florida, that tax is not going to be present. So a couple of great things there. But what are you seeing for the Florida market for the next 5 years?
Well, we're seeing massive population growth. It's been unbelievable what we've seen from a influx of people. Florida pre-COVID was seeing about 1,000 people a day coming to the state. I'm not sure that we even have accurate data on what that number is today, but I can tell you just anecdotally from what we see through the leasing department, significantly more. We have a lot of folks that are coming because they're allowed to work remote these days, and so we've really been a big beneficiary of the unfortunately of COVID. In the freedom that employees have been able to achieve by being able to work from home. So all of our markets are growing rapidly. We think that they're going to continue to grow rapidly. In addition, we think that rents are going to continue to go up because of just some fundamental limitations that are happening in the market today. One of which being there's just not enough lots being developed. There's been a multitude of changes in regulations in Florida that have required some longer permitting processes. It's still nothing like California. It's still a great state to do business in, but it has made it take longer to put lots on the ground, which is limiting the supply of housing that's able to support all of these people that are coming to the market. Kind of put a fine point on that. I watch the permit data in the Jacksonville area, 5 counties around Jacksonville very closely. And right now we're on track to do about 16,000 permits this year in this 5 county area. Perspective, 2005, which was the height of the building boom before the crash, they were putting 18,000 permits, so 18,000 houses in the ground every year. So we're still only at 16,000 right now, and we've had more than a 20% population growth since that time period. So it's really Jim had a slide on supply and demand. There is way more demand than there is supply at the moment. Which is obviously one of the reasons that we continue to see rent rates increase in the market.
Oh, I just to add on to that, it was really interesting. I was here in Florida in 2007, like the Fort Myers area, when things were about to kind of go funny. The MLS had about 3.5 years worth of inventory on the market. On the MLS for all the realtors, there's about 3.5 years of inventory. That means it would have taken 3.5 years to sell out at the pace it was going everything. And that obviously caused quite a big correction. Right now, in like Fort Myers, it's a little over 2 months inventory, 2 months. So that's a really big indicator that Chris and I look for. That along with something that we've seen and we felt, again, our company has, we thought we were big at 80 people. Now it's at 170 people, almost 170. We've learned that if you're going to get good help, you're going to pay for it. So we're watching the incomes going up quite dramatically in Florida. A lot of businesses are moving here, a lot of needs are here, but the employee wages are going up. And yeah, that's a little tougher for growing your business, but that's also a good thing for the business we're in because the rents, the income that people are getting compared to the rents we're charging is one of the best affordability indexes in the nation. So that's another thing we look at. And as long as those are continuing, we're seeing a really great growth pattern for Florida for the next 3 to 5 years.
A lot of people that haven't spent a lot of time in Florida, they think of Florida and they think of hurricanes. And you touched on this earlier about insurance. I wanted to flesh it out a little bit more. How do investors protect their investments, both from flood and from wind damage in with these turnkey investments?
Sure. Yeah. So I mean, it's very standard insurance policies, and they do cover wind as well. And really, one of the reasons that we get such great rates on insurance is because these are new construction properties that are built to current wind and building codes. So the insurance carriers, who they have a lot more people doing actuarial data than we do. They think that new construction is a much lower risk in any sort of windstorm. Now, I will tell you, in Florida, it's kind of like, we sit here in Florida and we think California is on fire all the time. The whole thing's on fire. But and I'm sure that they're sitting there in California going, "Oh my gosh, every part of Florida is getting hit with this hurricane." And really, the fact of the matter is that these hurricanes typically are not causing mass destruction in internal areas of the state where we build. So Jacksonville has a coastal component to it, of course. That there's great beach life in Jacksonville, but we're not building for rent houses on the beach in Jacksonville. Those are, all of our houses are inland. They're not in flood zones, so they're not, really in any sort of major danger from hurricanes. So it's, I can tell you, in our history, I cannot remember a single instance where we've lost a home to a hurricane that we built.
I think a lot of builders these days are concerned about supply chains, whether they're doing renovations, whether they're doing ground up builds. Supply chains are affecting all of us, but maybe affecting builders more than most. How are you guys handling supply chain disruptions and issues, and has it affected the time to build?
Just digging the knife right into my heart right there. The build times have been, frankly, horrendous. I mean, for all of us. I mean, every builder from us all the way up to the biggest national home builders. And that's one of the reasons that we've started selling the product later in the build process, because everything is delayed. I mean, everything from getting a surveyor out to the site to survey where the building pad is supposed to be placed, and where everything is delayed. And so we're trying to minimize those delays by selling once we've started the home. It doesn't stop there being delays. That's why we have such a, Jim gave a 4 to 12 month window of build time. Some of that's, whether or not the property is under, how far along it is under construction. But in good times, we should be able to build a home in 120 days, as a rule of thumb. Right now we're lucky if everything goes right in today's market to build it in 180 days, and everything doesn't go right all the time. There's constant delays due to window shortages, due to flex ducting. For AC units is on is an issue right now. So kind of every part of the supply chain has had its time to be a problem in the building industry. And what we've had to do internally is really just order and plan a lot further into the future. And that's something that honestly every builder is having to do, which exacerbates the problem, right? So we find a shipment of windows, but we don't just buy what we need tomorrow. We buy what we need for the next 2 months, and everybody else is doing the same thing. So it really is it's a problem that I think we're going to continue to see. But as builders, we're getting our arms wrapped around it, and we're getting used to living in this environment. I think for the longest time, we all just thought, okay, well, this is gonna last for about 6 months, and then it's going to go back to normal. And then once it just, nothing ever went back to normal. We just started, operating within the new normal, and it's really started to smooth things out. So I'm happy with the progress. It has resulted in a lot more people on our purchasing team to source materials than we've ever had to have historically. But it's it's certainly been a wild ride here the last year or so.
Now we're a little bit over an hour into this webinar, so I wanted to wrap this up pretty soon. But before I did, I wanted to give you a chance to tell us about who your ideal investor is. Who is this a good match for, and maybe who should not be investing with you?
Sure, Jim, you want to take that?
I think this is ideal. Yeah, sure. I think it's ideal for the busy professional that understands real estate, wants to get involved, but doesn't want to have to build their own team from scratch. They want to be looking at the long term, whether they're going into the income fund or building a portfolio. If you're in that stage where you're saying, "Gosh, I'd really like to add another 3, 5, 10 properties to my portfolio," I think that we are an absolute option. Not just because of the new construction, but also I think everyone should own property in Florida. Of course, that's the barber asking you if you need a haircut. But I think Florida has proven that for a couple of solid fundamentals right now. So I think we're for the person that doesn't want to be picking the paint colors for themselves and doing side work on the weekends. They are comfortable with trusting in the system. They understand the fundamentals. They believe in build to rent, and they want to own their own portfolio and look long term to it so that they can depend on it for cash flow and equity growth in the future. If they're looking to flip a property in 6 months, we're not for them. If they're looking to play interior decorator, we're not for them. There's the old saying, I know Brett will know this, general contractor for hire, $20 an hour, 50 if you help. That's the other thing as well, that you have to trust in our system of what we're doing. And that's who we've been able to create some really great portfolios for busy professionals out there, like investors in white coat. And that's what we pride ourselves on, because a lot of the times now, and you guys will see, most people aren't even offering these types of houses to anyone but the hedge funds or the institutions. Chris and I made a very deliberate choice 7 years ago to say, we're done with the big guys. We are going to hit singles and doubles with professionals, give them the investments. And I got to tell you, we enjoy our time so much more. I can speak for both Chris and I. So we want to work with people that want to work long term too. It is very, very, very rare that a person buys one property with us. Now, not that we're not willing to do that, but we like to build small portfolios for people, and that's what most people are looking for.
And it's really built a community is what it's built. I mean, it's great when we get everybody together, and I'm sure much like when you get all the white coat people together, it's amazing how many deals our investors do with each other and with us. And we've invested in deals of our investors because we've built these just great relationships. Growing everybody's wealth along the way, and that is the driving force for all of our staff, whether it be our building staff, our property management staff. Everybody along the way knows what the goal is. And the goal is to build that long term wealth for a client and do it with as little of their involvement as possible so that they can focus on their career that is providing that disposable income to be able to invest in these properties.
Awesome. Well, it's been great to have both of you with us. Thank you, Chris Funk. Thank you, Jim Sheils, for coming and telling us about these opportunities available with JAX Wealth Investments. If you're interested in learning more, you can go to the URL whitecoatinvestor.com/JAX, JAX. That's the landing page that will allow you to sign up to get more information. Whether you're interested in pursuing individual turnkey property investments and building a portfolio of homes, or whether you were interested in their income fund 4. Either way, same landing page, and you can get more information and ask all the questions you may have. Thank you so much for your time during this webinar. And let's do this as well. We want to make sure you know about the special deal they have for us. You want to tell us about that, Jim, before we sign off?
Yeah, so every white coat investor will receive $500 in closing costs to help give them an additional support to get into their first property, and that will be for each property that they do buy.
Awesome. And I think there's also a quote there from Brian Ballou.
Yeah. We're a big fan
let's
of
share that with them as well.
IPR Economics is someone Chris and I have followed for a long time. When I listen to them, I've made money. When I haven't. And they have this great saying that soon there will be 1 billion more people on the planet. 100 million of them will be in the United States alone, and they're going to require shelter. Brian says you can choose to be a part of that supply chain that eventually becomes shelter for the individual or family, and sometimes it isn't any more complicated than that. That is one of the reasons, this quote right here, we started our build to rent venture all those years back, and it's seeming to play out true. So I think it's something everyone should consider.
We should have started with that.
Yeah, it's a great Great way to think about supply chains in a positive way. We've been talking about them in a negative way for the
Yeah,
last 3 years. But, this is a
exactly.
chance to be part of a very necessary supply chain that, as you know, if you're living in an area like Salt Lake right now where there's a severe housing shortage, it's really a supply chain that needs to be beefed up, and you can be part of that. Not only make a good return for yourself, but provide affordable housing for people who really need it.
And Jim,
So, White Coat Investor,
Jim,
go ahead.
I would add as well that, for White Coat Investor, I went out and spent a whole day with Chris and with Jim. And we walked through properties, we walked through subdivisions. I met most of their staff, which, as they said, is a lot of people. Met people in everything from acquisitions to maintenance to other departments. And we were impressed, which is the reason we're working with them and even personally looking at these opportunities. So it's a great team here.
Yeah, it's a great endorsement. For those of you who may not know Brett as well, Brett is in his second career running White Coat Investor. His first career was as a general contractor by building high-end homes and renovating high-end homes. So he knows what he's talking about when he's looking at homes. He spent decades literally building them from the ground up. So it's a great endorsement, Brett. I appreciate that. And if you're interested in learning more about JAX Wealth Investments, go to whitecoatinvestor.com/JAX. Thanks for your time
Thanks,
today.
everybody.
The hosts of the White Coat Investor podcast are not licensed accountants, attorneys, or financial advisors. This podcast is free entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.